Welcome back, students. On this one, I want to explain simplified approach under Lessee accounting. Now, which situation are we talking about? We are talking about an example of TT versus a student, right? Now, this is basically the example that we made in the other slide when we were explaining the difference between general approach and the simplified approach. Now, let's take this situation. A student will occupy a room at any institution, for an example, for a year. After a year, you sign another contract, you see. So technically, the contract that you've signed, a lease contract that you've signed, is for a short period, because a short period here, it states that a short period is usually 12 months, right? And it does not contain a purchase option. Okay, so you're not going to say, I'm occupying a room now at TT for 12 months. After 12 months, say, I want to buy this room. No, no, no. You are not going to do that. TT will say to you, you can go home. We'll give it to someone else if you are not coming back next year, right? Now, for a simplified approach, there are two criteria. One, the lease must be for a short period, or, I'm not saying and, I'm saying or. So one of the two can be present in a lease agreement. So it must be for a short term, like I've explained, that the student can occupy a room for 12 months. Or it must be a low value asset. Now, let's look at these two criteria. Now, if you look at the situation that you're occupying a room for 12 months, already that makes it to a simplified approach. Okay. Or what can happen is, if you are occupying a room, a TT, and the whole residence building has got 50 rooms, you can imagine how much is your room compared to the whole building, which is 50 rooms. If one room costs TT 50,000 to build, now you can imagine how much is 50 rooms. But now from the 50, if you take one room and consider one room, it's not basically something that will become of a high value asset. It is low value, that room, compared to the whole building. Okay. Now, let's then look at this exercise here. I've got an example here where it says it's a simplified approach with tax and VAT qualifying. Right. Let's concentrate on VAT qualifying because it's why we need to pay more attention to. The cash price of the computer is 20,000, is regarded as a low value asset. Already they are telling us that this is a simplified approach because it's regarded as a low value asset, right? Now, what you must be careful of is the fact that when we are dealing with an exercise on a simplified approach and you are a lessee, this cash price of the computer, this one, this part here, is not relevant. There's nothing that you must do. You just read it and then you pass, because there's nothing that you're supposed to do with it. Okay, you cannot depreciate. You are not basically like using this asset, and at the end of the lease asset you're going to get ownership of it. You cannot depreciate, right? Now, here is the lease term. So it's 3 years, 2022, 2022, right? It's 3 years. So here they've given us the monthly installment, how we are going to pay, right? For the first 24 months is 500 for the first 24 months, and then 350 for the last 12 months. So in total, you've got 36 months. 24 plus 12 is 36. Now, what I want you to pay attention to is this part here, excluding VAT, right? If it's a VAT qualifying, these payments must be excluding VAT, right? You must use them excluding VAT when we do something called an equalization. I'll explain to you, right? But be careful that sometimes what we do in a paper, whether it's in a test or in an exam, there we write including, and then we give you the figures including. Here I'm talking about this for an example. Here we can give you a figure here, and here we write including VAT, and it's VAT qualifying. It is your responsibility as a student to identify that this is VAT qualifying and they've given me figures, the monthly installments that are including VAT. When you do the equalization, I'll show you what is the equalization. You must exclude VAT. Okay, be careful of that. Always read what is given to you here. It's very important, because if it's VAT qualifying, you must always have these figures here, excluding VAT, when you are doing what we call an equalization. And I'll explain to you what is the rationale behind that. The tax is 30%, VAT is 15%. The economic useful life of this asset is 10 years. And then profit before tax is 100,000 for the year, before taking into account for the years, all the years, before taking into account the lease transactions. Okay, right. So meaning before taking into account all what is happening in this exercise, you were sitting at 100. You must still take the lease transactions into account. The operating lease is a lease agreement as defined by the VAT Act. The lessee uses the asset for qualifying purposes. So it's saying here what I was showing here. That's what it gives us, that guidance, right? Now, let's make sense out of this. If you've got, these are the figures, right here, what I've highlighted. Let's think about this. Let's use someone who's renting a room. We are renting a room. Where have you seen someone paying 500 for 24 months, 350 for 12 months? When you are renting a room, they give you a price on an amount that you're supposed to pay. You stick to that amount for 12 months, you stick to that amount for the next 12 months. It's basically signed, right, that you're going to pay this much. Okay, so what we have to do first when we are dealing with this is to do something called an equalization of lease. We must have one lease amount per month, a standard one. That's what they're saying when we say equalization of lease amount. Okay, but I will then get to that. Now, here's what you are required to do. You are required to calculate the accounting lease payments, equalized lease amount. That's what basically I was talking about just now. Now, let's get to that. I will come back to number 2, 3, and 4. Now, number 3. Here's this thing called an equalized lease amount. Right, this part here. Okay. Now, you'll see it says 24 months times 500 plus 12 times 350 divided by 360. Sorry, 36 divided by 36. So it's 16,200 divided by 36. It tells you that a month is 450, right? And therefore, 12 months is 5,400. Now, what you are doing under equalizing lease installments, you are making sure that because now you've got 500 that side for 24 months, you've got 350 for 12 months, you are standardizing. It's a standard amount. You want one standard amount per month. Say, how much is a month until I get to 36 months? Okay. So this gives you that it is 450. Now, be careful here. All right. You remember what I was saying here about reading this? Right. What will happen if this thing was saying including? Including. If it was saying including here, when you get to here, you'll say 24 months times 500 times 100 over 115, meaning you're taking out the VAT. You remember? Because if it says including, you must take out the VAT. So the amount must always be used excluding VAT. You get my point. If that side it was say including, but luckily in this exercise it says excluding, so we use it as it is. Then it tells us that the standard equalization amount is 454 for 12 months is 540. But always read the question, when is the term starting in terms of a lease agreement? Some they start in the middle, you find that it's 450, but then for the first year you have to be using 6 months only, not the whole year. So always read the term here, which will guide you where you're going, the starting point to the end of that year, right? The equalization list is what basically we've done here. That's all that you're supposed to do. Get a standard amount in terms of this thing, okay? Now, let's check here. Number 2, they say calculate the current tax and the deferred tax and the deferred tax balance using the balance sheet approach method. Technically, they're asking us for 2 things here. The taxable income calculation and the deferred tax balance calculation. Okay, let's start with the first one. Now, here, which is on number 2, I've given you all the years to show you what is happening. Right, let's start with 2020. In year 2020, you've got 100,000. So remember, you still need to take into account the transactions of this lease. So you've got the accounting low value asset lease expense, which is this one here, the 5,004 that you've basically standardized to 450 per month. Okay, so you minus it as an expense. Remember, you are paying. You are the lessee here. You are the lessee. It's an expense to you. You are paying. You pay, and then you remain with 94,600. Right now, let's go to temporary differences. Always remember that the first thing that SARS does, they will cancel what you are doing. You see, now here's 54 here. It's canceling this 54. The first thing they do, they cancel, and then they put their own thing now. They will say to you, what is the actual low value asset lease expense? The actual one, meaning how much have you actually paid? Now, if you go back here, this person has paid 500 per month for 24 months, but for the first 12 months of that 24, the first one is 500 times 12. That's the actual amount that they've paid. Next year, they will pay another 500 times 12. Then the other year, it's 350 times 12. Okay. Now, here, the actual amount, 500 rand times 12 will give you this. It's a minus 6,000. Right. Then, your temporary difference is this one, is 600. This one, it's the difference between 6,000 here and the 5.4. Right. It gives you the 600. As a temporary difference. And remember, if it's in bracket, it means it is taxable. Taxable equals to liability. Right. Now, 94,600 minus 600 gives you 94,000 tax times 30% will give you 24,200. 600 taxable times 30% will give you 180. And if it's taxable equals to liability, remember, the liability sits in the balance sheet as a credit balance. Then the debit must go to the income statement, which is this debit here. Right. Now let's look at next year. Again, you start with 100,000. The standard is 54. Same as last year, 54. You reverse. You cancel this one. And then you put the actual amount, which is still 500 times 12. It gives you more or less the same thing. Right. And then you come to last year. You pay again 54, which is standard amount. And then it will be reversed here. And then the actual is 4.2 because it's 350. The last month here is 350, this one. Sorry, the last year is 350, which is this one. 350 times 12 is 4,200. Now, if you look at here, the difference between the two is 1.2, but this one is not taxable, it's deductible. 1,200 deductible. Deductible equals to asset. Debit, the balance sheet. Credit, the income statement. You'll see 360 credited here. Right, then 95 times 30%, which is the tax rate, gives you this. Right. So once you are done, you've answered the first part here. This part here. And then now we must go to the deferred tax balance method. Right. Which is this one. Now, let me explain to you so you can understand. I'll start with the 600 here in the first year. Right. Remember, prepaid expense is an asset. It means you've paid someone more than what you are supposed to pay. Okay. Now, let me explain the 600. In explaining the 600, I'll start with the 600 so that you can understand as we go along what exactly is happening. Now, let's come here. You've got a standard 5,004 per month. Okay. It's a standard amount according to accounting that you're supposed to pay. But let's look at this here, especially in relation to temporary differences, because it's where you're going to get an understanding. Accounting says to you, you should have paid 5,400. That's what accounting is saying. It's saying to you, you must always pay 5,004 every year. But you've actually paid 6,000 in the first year. So you've overpaid. Right, you've overpaid. The actual amount that you've paid is 6,000. But accounting is saying you should have paid 5,400. So if you've paid more, because you've paid 6,000, you've paid more, by 600. If you check 6,000 minus 54 is 600. So that 600 that we've overpaid becomes a prepayment. Okay. Now, if you look at next year, still the same situation. You should have paid 54 and you paid 6,000 again. Now, look, first year the prepayment is 600. The following year, your prepayment is another 600. So 600 plus 600 is 1,002. When I get to 2021, my prepayment is now 1,200 because it's 600 for the first year and 600 for that year. Okay, now let's check here. 600 for the first year. This is the difference between 5,004 and 6,000. I was supposed to pay 5,004. I paid 6,000. I've actually paid 6,000. So it's 600 for the first year. Now, because this is an asset, there is the tax value here is 0. Here is 600. So if the difference is like this one here becomes a difference that is taxable. Right. So it must create a liability when I come to this side. Right. It's CR liability. Right. Then remember it's 600 also again the following year. So 600, like I've explained it, 600 here plus 600 here. That gives me 1,002 now. So it's still taxable, this one. Right. It must also give me a liability. Right. Now, come the last year. When you get to last year, you're supposed to pay 54, but you actually paid 4,200. You see now here, you're not overpaying, you've underpaid. By how much? By 1,200. Now, already you're sitting with a prepayment of 1,002 by the time you get to 2022. But now here you've underpaid by 1,200. So it will cancel that prepaid expense. It will take it to 0 now. Okay. Now you'll see that is why I've got 0 here, 0 there, 0 in the balance. You are reversing the whole the whole 360. Right. So this one, for an example, is a debit. Right. If this one, it can't be a debit. This one is a credit because it's a movement. The debit is this one, and this one also. Right. It's a debit. So you can see what is happening. Okay. Now we are done with number 2. We move to number 3, the journals. Right. Now here are the journal entries. So here I've tried to summarize. I'm saying year 2020 and year 2021 is the same, meaning your journal entries will look the same for both those 2 years. Right. Let me just explain to you the first one. The first one, it is the actual payment. Right, the actual payment. So you paid 500 times 12, which is 6,000, right? Which is the 6,000. This one, 500. It's 500 multiplied by 12, right? Then that gives you 6,000, right? And then that's how much you're going to pay, right? Then you've got 500. You must pay including VAT when you make a payment, right? Remember it's times 12, and then you multiply by the VAT. It's 500 times 12 months times the VAT, and here it's 500 times 12. There is no VAT in that one. Okay. Then here it's the amount that has been paid. You want the VAT portion of that amount. Okay. Here it is. So this is how the calculation goes. It's 500 times 12, it's 6,000. What is the VAT that you must add on that amount? It's 900, right? You must actually pay 6,900, okay? Now, once you've paid that, it's an expense to you. SARS, the following month, they will give you the refund of the VAT amount. In the first journal entry, see you've paid this 900, so they must give you money. 900 it's input VAT, they must give it to you. So you'll see this 900 is cancelling this 900 because now you're paid back this amount that you've paid. Right. Now let me explain the last two journal entries first, and then I'll leave the current tax and deferred tax on, because those ones are easy, they emanate from here. So your tax in the first day is 28,200. Here you've got 180, which is sitting as a debit since this one is taxable. Okay, since this one is taxable, it creates a liability, debit income statement, credit the balance sheet. Right. Now, current tax 28. Here 28,200. We are raising this one in the balance sheet as a liability. This one is an expense in the income statement. Then here under deferred, it's 180. Because remember we said it's taxable, it must create a liability, debit the balance sheet, credit the income statement. Okay, now let me come and explain this one here. Already I've explained it, but let me repeat it again. Rest one here. Right. Now remember what we said. If you look at here, the standard amount that you are supposed to pay is 5,400, but you've actually paid 6,000. Right. So you've overpaid. You've actually paid 6,000, but you are supposed to, according to accounting, the amount you are supposed to pay is 5,400. It's just like having a debt. You can imagine if there's a debt of 5,400 and we pay 6,000, we've overpaid by 600, isn't it? Right. But here now we are talking about an expense. If there's an expense, for an example, let's think about it. If it's rental, your rent for a month is 5,400, and you decide to pay 6,000, you've overpaid. So you've created what we call a prepayment. Right. Now, prepayment is an asset, debit, prepaid expense, credit, operating lease expense. Okay. Now, what is the purpose? Why are you crediting operating lease expense? Because you are targeting this figure here, 6,000. Right. This 6,000 must be reduced to 5,400, the standard. So if you check 6,000 minus 600 here, it reduces it to the standard. Right. That's the intention. Every time you are trying to look at this figure here and bring it to 5,400, right? Depending what is happening in terms of that figure. Okay. So you'll see that this 600 reduces this 6,000 to 5,400, and then you raise your prepaid expense. Right. Now we have addressed all the journal entries in that slide. Then we move to number 6, slide 6. See, this is last year, 2022, right? Now, in 2022, remember, we are paying 350, right? Now, this is 350 times 12 months. And here, we are paying 350 times 12 times 1.15, meaning including VAT, right? It gives you this amount here, right? And here, it's the VAT portion of that amount. It's 4830 times the VAT amount that you want here, right? You've actually paid 350 times 12, which is 4.2. The actual payment that you are making should include VAT, which is this, times that. Sorry, that gives you 4830. The VAT is 630. That 630 must be paid to you. You receive it here in the bank. You cancel what you've raised here. Okay. Right. Now, tax. In the last year, you've got tax of 28,740 and the deferred tax of 360, but it's a credit, this one, because the 1.2 is deductible. Deductible creates an asset, debit balance sheet, credit income statement. Okay. Now, here it is. You've got the tax raised for that year. Remember, now we're creating an asset, debit the balance sheet, credit IS. Now let me check this one because the figures are not the same. It's 360. Yeah, it's 360. So we must just delete a delete here. It's 360. It's like that. Right. Now we've addressed now number 3 with the journal entries that we did. Now we're left with number 4. Right, here's number 3. No. Let's finish this thing because there's a part that we have not addressed. Right, the taxation. Now let's address this one here. Right. Now pay attention. 5.4 is the standard amount, but we actually paid 4.2. Now you see now we paid less now. Here we've got a problem. We paid lesser than 5.4, which is the standard amount. Now let's look at this thing. This is how I always look at this thing. You see this thing is 5.4, the debit, the expense. Now my standard is 5.4, so I'm less. The debit side is less because it's supposed to be 5.4, this debit side. Now I'm short of 1.2. 1.2 plus 4.2 gives me the 5.4. Then I cancel the prepayment of 1.2 this side. All right. Now let's look at the difference between the two. How you have to deal with this thing. You see this one is 6,000. The standard is 5.4. So your debit is more. You're supposed to reduce it such that it gets to 5.4. That is why you're reversing 600 in this one. You see, then it takes you to 5.4. In this one, 4.2 is lesser. You must increase it. You must go up. So you see that is why you debit 1.2 here to take this one to 5.4, the standard, and then you reverse the prepayment. Okay. All right. In other exercises, it is income. I think there's a prepayment first, whereby you've overpaid. Sometimes you can underpay, and then it becomes a liability when it starts. Where if it starts with an underpayment, that's the situation, right? Now let's address the last one. In terms of those requirements, it's a note. You're supposed to do notes according to this page. Number 4, disclose the above mentioned in the notes to the financial statements. Now your notes will look like this. Right. The first one is other expenses relating to leases not included also in this note. You must give us the raw value asset lease expense of 5.4, which is the standard one. And then you must give us the maturity analysis. Remember, in 2021, meaning you start from the following year. We are doing 2020. When you do the disclosure, you start from the following year, right? Because currently it's 2020. Now, in 2021, which is my following year, I'll actually pay 6,000. And then in 2022, I will then actually pay 4.2. Then we are done with the notes. It's not basically complicated like general. This one, you just put the two notes. Then you've put your disclosure in terms of this one. Let's go to note 8, slide 8. Here I'm saying, try this on your own. You've got a low value asset of 28,000, but remember I said it's irrelevant when you're Lessee. That you don't do anything. Here's the situation I was telling you about. You see, it's written including, and I've given you the figures it's including. Remember, if it's VAT qualifying, these figures here must be excluding VAT when you're doing the equalization. Okay, so I'm saying use the same exercise as the one that we're using. The required must be the same. Okay, so you answer what we are doing on the slide based on this exercise that I want you to do it on your own. All right, thank you.